Silver has been in backwardation on and off, mostly on since October 9th when it first hit 50. And every time there is a sell off in silver, the backwardation reasserts itself. So it looks like this backwardation is becoming permanent. And what happens after permanent silver backwardation is permanent gold backwardation, which means that nobody wants any dollars for any amount of gold anymore, and the dollar cannot buy anything at all. Once silver backwardation becomes permanent, gold is next.
Obviously, the fact that we had this huge drop just after the end of January is worrying them that it might happen again. But on the other hand, we've got some shorts wondering if it's going to shoot up to all-time records the next day or two. And they're also closing. So both sides are closing. We probably will have a fairly orderly settlement. May open interest is rising rapidly. So we can see that a lot of people have rolled their contracts into May.
Persistent backwardation in the silver market has begun to signal deeper structural tightness between physical supply and paper pricing mechanisms. Since early October, backwardation has reappeared following each corrective move, suggesting that immediate demand for deliverable metal continues to outweigh future contract pricing. As open interest rolls into later delivery months, market participants are increasingly adjusting their positions in anticipation of heightened volatility across both the silver and gold markets. Rafi Farber, alongside market analyst Clive Thompson, points to the implications of sustained backwardation as a potential precursor to broader monetary metal repricing. They note that if silver backwardation were to become entrenched, similar dynamics could eventually emerge in gold markets, reflecting declining willingness to exchange physical metal for fiat settlement. Such a shift may reinforce upward pressure on both metals, particularly as short positioning begins to unwind in response to tightening availability. This trend is strengthening the outlook for further upside across the precious metals complex. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver in the right form, in the right place, ready to be sold as to meet the March contracts or future contracts as well. Open interest, you can see it's coming down very sharply from last Wednesday. It was 268, then 239 million, then 222 million, then 188 million. And the latest figure, which is as of yesterday, this is the close of business yesterday, the open interest was 114 million ounces, equivalent to 114 million ounces. Probably with the direction of travel, today will be much lower, 25th. And then, of course, 26th is that's Thursday this week. So we don't know the figure today, Wednesday. We won't know the figure for Thursday until Friday, but 26th is the day when, if you are long, you need to be out of the contract if you do not intend to take delivery of the silver. So anyone who, by the close of business on the 26th of February, is still long the futures contract, the March contract, is basically signaling to the market that they have the cash and they have the infrastructure and are ready and able and willing to take delivery of the silver. They don't know when it's going to come, but in all probability, the vast majority of shorts will decide to deliver the warrant or give notice on the 26th. They'll give notice on the 27th, and that means the vast majority of that silver will change hands on the 2nd of March. There will, of course, be some shorts in the silver market who haven't got the silver yet, and they'll be perhaps hanging on, hoping that they'll get a better price on silver further down the month. And there'll be some longs who don't really intend to take delivery of the silver, but who are just hoping to squeeze the shorts as well. So there'll be an ongoing battle for the next few days, and as we go into March, right through to the end of March probably. Looking at the registered silver, and the eligible silver, we're continuing to see a drain on silver from the CME warehouses. That's going on. We've got very little silver, in fact, no silver at all coming into COMEX. One of the reasons is the problems with transportation in Mexico. It's become very dangerous to transport silver bars. So some of the silver miners are now transporting the ore, the dirt, to refineries elsewhere, which obviously the dirt is less attractive to steel then because the cartels don't have silver smelting facilities, so they're not going to steal it. Of course, there are some dangers there too, but they're not shipping the silver bars directly to CME warehouses at the moment because of the transportation and the risk of theft. So that's slowing down the process. Nothing's coming in yet. It might come in when the thing sorts itself out, hopefully in a few days, if not before. But yeah, we're seeing the eligible silver and the registered silver go downwards. Probably the open interest will be about equal to the registered silver when we get to the 26th or the 27th of February. So I'm not expecting any fireworks. The silver price, hard to say what it will do. It depends on who chickens out first, whether it's the shorts or longs. But as things stand, we have open interest for 114 million ounces, but only 87 million ounces available to be delivered. But that 114 million ounces looks like it will go down to 87 million or below as we speak. On the right-hand side, you see the silver price, not rising every single day, but suddenly trending upwards by about 15% in a week. And that indicates that the squeeze which we talked about is to some extent happening. It's not a major squeeze, it's a little squeeze which is happening. A lot of longs are capitulating very quickly. Obviously, the fact that we had this huge drop just after the end of January is worrying them that it might happen again. But on the other hand, we've got some shorts wondering if it's going to shoot up to all-time records in the next day or two. And they're also closing. So both sides are closing. We probably will have a fairly orderly settlement. May open interest is rising rapidly. So we can see that a lot of people have rolled their contracts into May. They've sold March and bought May. So we'll see how that plays out. Just a short comment. Last year in March, there were 80 million ounces of silver delivered, or the notice was given of delivery of 80 million ounces. So probably it'll be a bit more than that delivered this time, based on what we've seen so far this year. And of course, there's just enough in the CME warehouses for that. But the silver won't leave the CME warehouses. It will still stay there. So it doesn't mean as that registered silver figure, which you see here of 87 million, will go down to zero if 87 million are delivered. All that will happen is the silver will stay where it is, the warrant will change hands, and there'll be a new owner. Then the new owner can decide what to do.
Silver futures positioning has shifted sharply as open interest declines into the March delivery window, reflecting the transition from speculative contracts toward potential physical settlement. With registered inventory levels continuing to fall across CME warehouses and logistical challenges slowing inbound supply from key mining regions, the balance between deliverable ounces and outstanding contracts has tightened. This narrowing margin may influence near-term pricing dynamics as participants roll positions forward or signal readiness for delivery. Warehouse data suggests that available registered silver could soon align closely with remaining open interest, reinforcing the possibility of continued upward price pressure during settlement cycles. While large-scale dislocations are not currently expected, even modest squeezes have historically contributed to accelerated price movement in the weeks leading up to contract expiry. Ongoing contract rollover into later months indicates that market participants are preparing for sustained demand beyond the immediate delivery period. Let's get back to the interview.
From somewhere around 1990 to 2008, you can see monetary stability here. This is the gold CRB ratio. How many ounces or how many baskets of CRB index, which is the commodities index, can 1 ounce get you? 1 ounce of gold. So this is the higher this is, the more valuable gold is relative to all other commodities. So here we see from 1990, it goes before 1990, from about, let's say 1985 or so. 1990 to 2008, we had pretty good monetary stability. Gold's value was stable relative to a basket of other commodities. And then from 2008 until about 2020, you see that things have started to get a lot more wobbly over here. right? And slowly the other commodities were degenerating in favor of gold, which means that gold was getting more expensive and other commodities are getting cheaper in real money terms. This is when credit gets less and less valuable and money becomes more and more valuable because they're printing credit too much. And this is what happens. And then you see extreme monetary stability over here from about 2020 to now. This is not normal. It should never be this way when credit is even relatively stable, which it is not at all. You can see the monetary instability is getting worse and worse, and it's going to just fly completely out of control in the end game. We're almost there. One of the reasons why I'm calling the bottom in the silver price, this is silver open interest. It says here 134,620, but this is on a 1 day delay. The actual CME numbers are now 126,789. There was a huge drop from yesterday, and I'll show you exactly why that is. It's about 8,000 contracts, a little bit less than 8,000 contracts fell off yesterday. That is February 24th, because today's the 25th. So you can see here that at the last time we were at this open interest number, we were slightly above it here. So this is the last time in late 2023. This was the price of silver back then. It was about 22 maybe, or $23 maybe, something like that. We haven't been anywhere near there since. It hasn't ever gone below that since this number in open interest was hit. And we can see here that we almost hit the open interest here. We were slightly above it at that point. But even in this neighborhood, it only hit that price again. Silver only hit that price again one time below 30 in April of last year. And ever since then, it's been flying off the hinges. And it looks like we've bottomed over here at about 66 or 65, whatever that candle was. And now we're back above 90. I don't think we're going to go below this bottom. I don't even think we're going to go below 70. I think the correction is done. Here's another reason why. So the 126,789 contracts I showed you in this chart over here, where this little black line is, and I drew it in over here so you could see it. So this is the COMEX tables, the CME tables of what happened in silver trade yesterday on the futures. So you can see March silver over here. This is the active contract. It is rolling off, and it's becoming spot in the next 2 trading days. So because today's the 25th, so we have the 25th and 26th, and the 26th would be the last trading day of this contract as a futures contract. So you've got to roll out of it. You've got to roll to the next contract in order to keep your futures position. Otherwise, you risk delivery. So what is happening here is that 14,196 contracts closed out, meaning those shorts were bought back. Those contracts no longer exist. And usually you'd see a similar amount or even a higher amount rolling into the next active contract to maintain the futures position. But here we had 14,196 closed out and only 5,350 new ones opened. So a lot of positioners, whether they are bullion banks or whoever they are, that had these contracts long, they closed them out and they didn't roll them over. Why didn't they roll them over? Well, if they're a bullion bank, they can't do it profitably because the price of London spot silver is still higher than New York futures, and it's been that way on and off since October 9th of last year. Bullion banks cannot provide liquidity in this market because they cannot profitably hedge. It's been that way for almost 3 months. Or is it 4 months? October, November, December, January, February, 4 months. Over 4 months, it's been that way. This is silver backwardation looking like it wants to become permanent. And you know what happens after silver backwardation? Gold backwardation, which means the end of the dollar. That's what it means. So SLV is being used for quick trades. I just want to show you what's happening here, what has been happening since the silver crash of 2026, of January 29th, 2026, what happened in SLV. So you saw here, here's the crash of the silver price moving from about $110, $120 to about 70 in a day, whatever it was. It was a huge 120 to 70. Wow, that's like $50, $50 in a day or two. Oh my gosh, that is nuts. So we were all waiting for silver to hit $50 for like since 46 years, and then all of a sudden it didn't. It fell $50, and it's still at like 90 now. Okay, whatever. But you see here, the total metal in the trust went way up on January 29th. I think this is the third biggest influx of silver behind one other day in 20 something and silver squeeze in 2021. But this is a huge day of about 35 million ounces of silver flooded in on that crash, and that was bottom pickers, right? They were buying SLV because they wanted to. They saw that the fund would probably jump up as the huge crash would be corrected somewhat. And you can see here, since they did that, since they bought silver on that day, and then silver had to be flooded into the fund because of all those bottom pickers. But then you see since then, silver has been drawing out of the fund as these traders have sold their shares for that quick bounce. And it looks like they might have gotten a few bucks on that, and good for them. But there's no sustained interest in SLV here. It's just the retail crowd is still dead. There's no interest in this ETF, it looks like. That was just bottom picking.
The gold-to-commodity ratio continues to reflect a shifting monetary landscape, where credit expansion has gradually weakened the purchasing power of industrial assets relative to hard money. Since the global financial crisis, gold's ability to command a larger share of commodity value has intensified, signaling mounting stress within debt-driven systems. Recent positioning data in silver futures further supports this transition, as declining open interest alongside limited rollover activity suggests a reduction in speculative exposure and the potential formation of a price floor above recent correction levels. This evolving market structure aligns with tightening physical availability and persistent backwardation across select trading hubs, reinforcing expectations that monetary metals may continue outperforming broader commodity baskets. As silver stabilizes above prior lows and gold maintains strength against fiat currencies, long-term projections for both metals remain skewed toward higher valuation ranges in the coming cycle. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.